The macroeconomic releases traders are watching and understanding the volatility term structure. Today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. So we're going to talk today about some of the macroeconomic releases that investors and traders are going to be paying the most attention to this week, including some of the stuff that we had today, which included the S&P Global U.S. Manufacturing PMI and ISM manufacturing data. The S&P Global U.S. Manufacturing PMI was expected to hover near 52.3 based on recent trends, signaling the health of the manufacturing sector, a key driver of GDP. A reading above 50 indicates expansion, which will boost confidence in industrial and cyclical stocks, while a contractionary reading below 50 would pressure these sectors. Given recent tariff uncertainties and the Q1 GDP revision to negative 0.5%, this release number came in at 52, just under the survey, but still showing expansion. The ISM manufacturing PMI was forecast to be around 49.5, but that came in slightly light at 48.5. And that provides a broader view of manufacturing activity, with sub-indices such as employment and prices paid offering insights into labor markets and inflation. After contracting at 49 in March of 2025, a rebound above 50 would have signaled recovery, lifting equity sentiment, particularly for industrials and materials. And I just wanted to quickly show a couple things here. So first things first, if you're looking at my screen right now, this is just from UnusualWhales, which is going to show the economic reports, what the forecast is. You can see here 52.3 was the number that was forecast for the manufacturing PMI number, and the ISM manufacturing number over here. You may be wondering, because on any given week, and let me see. So I've been informed that when I move images rapidly around the screen, that that tends to bog down my bandwidth over here. So I'm actually going to see, let's see what this looks like for you guys. So this is the Bloomberg. I wanted to just show the Bloomberg in addition to UnusualWhales, because I wanted to show that in any given week, there's actually quite a lot of economic data that comes out. So you can see this is just for this week through the 9th. Just fast forward all the way to the end of the week here, which includes all of the initial jobless claims on Thursday, non-farm payrolls, and the unemployment rate on Friday. How do I establish which of these data points I'm going to pay attention to? Well, if you're looking over here, you're going to see these little bars. And what those bars indicate is how many people who have the terminal have actually hit this button or this button. And what that does is it alerts the user when those numbers come out. So a little bit like taking a look at Google search queries, this essentially is giving me this gives me essentially an indication of, so I can have on release, for example. So, and I can actually click this to just say play an audio. So this would actually just alert it. But what this is doing is telling me what all other users, and there are hundreds of thousands of Bloomberg terminal subscribers, are doing. So anything where you see all 5 bars lit up like this, a full signal, essentially that's saying a lot of people have indicated that they want to be updated and get a notification bell, essentially, for these particular economic alerts. So just to highlight, and I'm going to get rid of this because you don't need to look at this big sea of numbers. As it happens, when you look at UnusualWhales, effectively they must be doing something very similar, just taking a look at the things that people are most interested in, because you can see they've paired the economic calendar to a smaller number. They basically look like they're highlighting essentially the top 5 most active. So the ADP employment data, which comes out on Wednesday, for example, you could see that there's a lot more economic data that comes out according to the Bloomberg terminal. But it's these, these are essentially the key ones to take a look at, and we can see that there's actually fairly close alignment. So you get both the survey numbers and the actuals once they come out, if you're looking at this on UnusualWhales. So I think that's something important. And again, Actually, somebody was asking, I guess they had some kind of a question. We do have an affiliate link for Unusual Whales in the description, I think, for this video, and you should get, I think, a 20% discount. But somebody put the code in and didn't get it, so I have to check on that. I will. And actually, now that I just happened to be using the Unusual Whales terminal. By the way, just so you guys know, I actually get charged by Unusual Whales. I happen to be reminded of that when I got my renewal, so I am a paying subscriber for Unusual Whales myself. But yes, this is sort of the things to look at, and I just wanted to bring this up because I think it's kind of important to know which of all of the economic releases that are coming out on any given week are probably most likely to move markets. So just wanted to point that out. So I also happened to write an article which was published on the CNBC Pro website. I think it was over the weekend, or maybe it came out first thing this morning. And I just wanted to talk about that a little bit, which is term structure information. So how we look at term structure and how we think about that. So I'm going to pull something up here, and we'll just go to volatility. And I'm trying to remember what my first example was. I think my first example was, oh yes, that's right. It was Dick's, because Dick's had news coming out. So I'm going to put that in here. And I just want to show this implied volatility term structure, and then just talk a little bit about what it is that I think people should pay attention to, and how you can identify trading opportunities by looking at the term structure. So the volatility term structure plots implied volatility against different expiration dates, which you can see here. So the y-axis is the implied volatility, and the x-axis in this particular chart is the days to expiration. So you're going to be looking at the term structure for a given underlying asset. Now, what's interesting about looking at the term structure is one of the things you can do is, so Monday Morning Quarterback said that I had a problem with the unusual discount code as well. No big deal. Well, if they tell me that you guys get a discount for using the code, I just want to make sure that you actually do. So, big deal or not, just want to make sure that everything is as it is described on the tin. So we will look into that. Okay, so you're going to look at the volatility across various time horizons, and that's going to reflect the market's expectations for the volatility of the underlying asset at various moments in time. Now, why do we want to look at this, and what's important about it? Well, when you look at the volatility term structure, one of the things you can see is whether there is higher expected volatility around certain periods, and that gives you a sense of whether there's going to be news coming out that you should be paying attention to or not. Now, I just want to give some sense of how you want to look at this. So, for example, if I see, as we can see here, that the volatility is actually much lower here. So implied volatility is sub 40, as we can see, over the course of the next 60 days or so. And this is in the context of actually very high realized volatility. So the volatility was really bumping around, and that's because there was a lot of news coming out. We had earnings, we had their takeover of Foot Locker, so the stock was really bumping around. But now we can see that there's not a whole lot expected right in here. But then you can see that right in this time frame, between 90 and 120 days, that the term structure increases sharply. Well, why is that? The reason is because the company is expected to report earnings in September. So we can come over here. Let's see what we have. There we are. September 3rd, according to Unusual Whales, that's the anticipated one. So that's going to be outside of 90 days. But that helps explain why the term structure looks like this. So when you see the term structure go up, oftentimes you'll see it fall just thereafter. And the way to make some sense of that is to think that if we think about volatility as basically an underlying process, so how volatile the stock is in general, And then we think about event volatility or event variance, which is the amount that the stock's likely to move when new information is released to investors. So what will happen is that if you're looking, this volatility looks lower, but that's simply because as an average, it's going to come in. So in other words, if the earnings is going to be, let's say 15 days from now, the 15-day straddle will have an implied volatility that reflects the underlying process plus that earnings day. The 30-day straddle will also incorporate the underlying process and that one day, but you're dividing, the divisor is going to be bigger for 30 days, for 60, for 90, and so on. So that's the reason why you see that sort of backwardation after an event takes place. Okay. So this gives us just sort of a general sense of how to think about this and how to use it. I came up with some other examples that I was showing for term structures. Lulu's going to be announcing earnings this week. Unsurprisingly, you can see implied volatility is very high. I think they come out on the 5th, so that's going to be on Thursday. And I also had used as an example Domino's Pizza. DPZ. Get a little bit of a bump up here because they're going to be reporting a little bit later. So not a whole lot in the front month, but then you're going to see it because they're going to report in July. What I was looking for and where I think this is important and what you should be focused on is, so everything I've just said should not be coming as a surprise to any of you, which is that big whoop, Mike. Stocks are more volatile when they report earnings, and options prices should reflect that increase in anticipated volatility. So how do you use this information then to try to find situations where things may not be priced correctly and there's something you can take advantage of? So I happen to be looking at Intuitive Surgical, and Intuitive Surgical has this clear event variance. We can see that. So low here, higher, and then dropping again. So there's an event in here. And if we take a look, we can see that the July expiration, so this is July 18th, is materially higher than the front month options. In fact, all of these weekly expirations. So clearly, the options market is expecting something to happen between this date, July 11th, and this date, July 18th. But what's curious is that you'll notice that the August 15th options are again higher than the July 18th options. Why is that? Because what the options market is kind of saying when we look at this chart is something happens before July 18th, between the 11th and the 18th, and then something else is going to happen between July 18th and August 15th. Well, if we take a look at, say, what's the most obvious thing to move a stock around? It's going to be earnings. So if we go to earnings, we can see July 17th. Well, why are the July 18th options higher than 11? Well, because you've got earnings on the 17th. But then why are August higher than the 18th? That doesn't make much sense. We would normally expect, as we were talking about those averages, for the volatility to fall off. Well, one of the things we can take a look at is this is just an estimate. So, by the way, this estimate, the 17th, that UnusualWhales here has, it coincides with what NASDAQ and Zacks had. So, NASDAQ, Zacks, earnings. Let's see if this comes up. So I was looking at this, and that's April 22nd. When is their estimated earnings? I actually had screen grabbed it, and I wish I'd kept that. I can probably find it. They had the 17th. And let me just quickly pull in Bloomberg so we can take a look here. What does Bloomberg have? They have the 18th, I believe. Yeah, they did over the weekend. Still the 18th. Okay. Well, let's think about this for a second. First of all, this date right here should immediately set off an alarm bell. Why? Because July 18th is also options expiration. When is options expiration? Regular way? the third Friday of the month. How often do publicly traded companies release earnings on expiration Fridays? Not very often. Generally speaking, companies like to report earnings before expiration. And in fact, if we take a look, I actually went back for 11 years. Intuitive Surgical has only reported on Tuesdays and Thursdays. The 44 most recent reported quarters, only on Tuesdays and Thursdays, not on Fridays. Fridays are very uncommon. You know, we've got Berkshire Hathaway. They announce their earnings after the close on the weekend. So what I think is going on here is, you may remember that last year I spoke about this a lot, that many times, so algorithms are what are used to estimate when a company is going to be releasing their quarterly earnings report. And basically what they do is they take a look at, you know, the boundary conditions. So the company never reported before the 17th, never reported after the 22nd, for example, and then it just comes up with something that's as close to that as it can. Last year, there were a lot of errors in these algorithms, and the reason was a fairly simple thing that apparently they didn't account for, which was that last year was a leap year. I don't know what the problem is here, but there's clearly a difference of opinion, because there is an increase in volatility associated with the 18th, and we can see that some people think earnings are going to happen then. But then there's even another step higher in implied volatility for the subsequent expiration, which suggests that some other people think it's going to be later. I am in this latter camp. Why is that? So first of all, for the second quarter of the year, in the last 11 years, the company has never reported the second quarter earlier than the 18th. That's probably why Bloomberg has the 18th, but that's a Friday. They've never reported on a Friday. They have not reported after the 23rd. I believe that they are going to be reporting on Tuesday, July 22nd. And because I believe that, I think that people who are pricing the move into July are doing so improperly. And if they are, then that should set up for a calendar spread. Now, here's the thing. What if we're wrong? What if, in fact, they end up reporting on the 17th? They've never reported as early as July 17th. And they have reported as early as the 17th for other quarters, but not for the second quarter. Why is that? I can't say for sure, but one of my guesses could be that, you know, maybe that because there's some holidays, you have the July 4th Independence Day holiday. That could be a potential reason why, if you're going to air earlier or air later. My guess is they report on the 22nd, but I think you're not going to be risking a whole lot if you get into a long calendar spread in Intuitive Surgical, betting that the July options are a bit overpriced. Because what's the worst thing that happens? They do end up reporting in July, and you own August if you do something like that. So this would be a trade, unlike my normal calendar spreads, where I'm typically looking to do, you know, maybe I think the implied move is too high, so I short the implied move for one earnings, but try to make sure that I own at least two earnings for the subsequent one. So that would mean if they're going to be reporting on July 22nd, you go, you know, 100 days out, and now I've got to own October options. In this particular case, I'm really playing on, do they announce their earnings on or before the July 18th expiration? If they do, no, not too much harm or foul, because I'm going to actually have the August options on. Yeah, I didn't change the symbol yet. So this is a trade you would want to modify before they actually report. So if they report after the 18th, then you would want, which would mean that it's going to be a limited amount of time to deal with this. So what's probably going to happen is, when they actually formally announce when the earnings will take place, the July options will adjust accordingly. So assuming that they say, okay, they're going to be on the 22nd of July, when that takes place, the July vol will get sucked out, and you can, you know, unwind the trade at that point. So I'm just going to give a very quick example of what doesn't really matter. I mean, this is really for illustrative purposes. So I'm using a bullish trade here, an upside call calendar. In fact, what I had proposed in the CNBC article was to sell the 600s, buy a higher strike, because I was really just trying to hedge the higher strike 620s, and then sell another July downside put, maybe a 16 to 20 delta put. Here's one standard deviation. This is probably a little bit out of whack because we're dealing with post-market prices, because I could see that the delta of the lower strike option, see how this is a 16 delta and this is a 15? Yeah, that's not correct, right? That's only because the model is picking up the closing prices, which probably widened out a little bit. So intraday, this would never be the case. A higher strike put is never a lower delta than a lower strike put. Just like a higher strike call is never a higher delta than a lower strike call. I'm sure you guys know all that, but obviously the higher the strike of a put, all else equal, the more it's worth relative to a lower strike put. And the delta is going to be the same way. But in any case, this is one of those things that I think is really important. And that, people talk about the term structure all the time, but they don't actually say, hey, look, this is how you use it. Map the term structure to known events and catalysts, and then do your own work. So, this just happened to be one I bumped into over the weekend. All I was looking for that led me to this, by the way, was I was simply looking for term structures that had kinks in them. Situations where it was in contango in one spot and in backwardation in another, which we can see here, right? So contango, backwardation. And I was just going through different names, found one that was there, looking at the earnings, seeing whether it made sense. But this one, what immediately caught my eye and said, that seems a little bit off. Why was July so much higher than the July 11th weeklies, and why was August then higher than that? So this is substantially higher than the 11th because the options market is pricing in a catalyst or a potential catalyst. And this is higher than this because it's pricing in another catalyst. Is it possible that you could have two catalysts back to back within, say, 30 days of one another? Of course. You could have the Worldwide Developer Conference and earnings at Apple, for example. So you could have two different things that could potentially be market-moving events. But sometimes you don't. In this particular case, I didn't identify anything. So that's why I wanted to talk about that with you guys so you have something to look at. Okay, so let's move on. Take some questions here. FinWest, hi Mike, caught up on Friday's stream. Curious to see the review of CSX. Yeah, last week somebody brought up CSX, trading around 13, 14 times, I think. And there was a lot of unusual call volume in it. I didn't actually happen to check to see, was there follow-up volume today? Let's see. Whoa! Yes, there was. More buying. Sept 35, 17,600 trade. We're up to 46,700 now. And also the Jan 35s, I don't know if you can see this, those have a substantial amount of open interest as well. Interesting. I wonder what that's all about. What's going on by expiration that could possibly... We've got a dividend X date. That's not it. We have earnings on August 5th. That's not it. Or shouldn't be. I don't know. I mean, like I said, I think CSX is a reasonable valuation. I think that maybe some economic concerns are overblown. I actually highlighted this, I think, on Friday when we talked about the name. Yeah, so $1.92, that's next year's full year. 31.24. Actually, that's 16 times. But that's 16 times with anticipated 4.5% top-line growth, which meets my criteria for... Well, actually, what's interesting? This came out, if you guys didn't catch this, the Atlanta Fed came out with a revised GDP number. Let's see if I can find that story. This is, Yeah, so GDP Now index rises to 4.64% from 3.84%. The Federal Reserve Bank of Atlanta's GDP Now index suggests U.S. gross domestic product will expand 4.64% in the second quarter versus 3.84% in its previous release on May 30th. So I thought that was kind of interesting. Okay, so why do I bring that up in the context of this? Because one of the things I look for, if you're going to pick a stock, it's got to be, number one, I want to hopefully see a stock that is a company that's growing its top line at least as fast as the economy. This one's now close, given the Atlanta Fed's new forecast is 4.6. This thing is forecast to grow at about 4.5%. So it's in there. It's not exceptional. But the EPS growth, the adjusted EPS growth of 16% is pretty solid. That's actually better than the company's reported in any of the prior 5 years. And if you can get something at 16 times forward earnings that's growing EPS, adjusted EPS at 16%, it's not a bad do. Do I know why people are buying all these call options in CSX? I don't. But it is interesting, and it is consistent, and it is institutional, and it is unusual. So put all those things together. Somebody wants to speculate on CSX on the long side, I'm on board with that. Pardon the pun, it's a rail company. Okay, Michael Caine says, as war continues in the world, unfortunately, when is it not continuing in the world? And what I mean by that is, between the GWAT, Iraq 1 and 2, we just don't seem to be able to get out of it. But anyway, be that as it may, NATO ramps up their military budgets and President Trump will propose $1 trillion defense budget. Why aren't defense stocks reflecting this upcoming spend? I think they do, actually. Let's take a look at Lockheed, for example. So, yeah, Lockheed is trading, well, full year, where are we at? 480. I'm just going to use round numbers. 480, 27.4. So it's trading 17.5 times full year and 479. Let's call it 29.85. 16 times. So that's, it's a reasonable valuation. But, the forecast is, again, for around GDP-like growth, because this is a big defense budget, but it's always big. It's not many orders of magnitude bigger than it usually is. The other thing I would say is that we have seen some indication that they're trying to move away from more conventional military spending approaches. So the cost plus, now I happen to like Lockheed, I happen to like the defense contractors, but, so Anduril is not publicly traded, which is Lonsdale's business. And then you have things like Palantir, of course. What is interesting is that, of course, the way this typically works, the military has certain specifications. There are things that they want. They put these things out to bid, and then, they work all of this stuff on a cost-plus basis. That's not what Anduril is doing. Anduril is basically trying to innovate defense products and then present, complete product ideas and say, hey, this is what we created. Do you want to buy it? And I think one of the overhangs for the conventional defense contractors is that if the industry starts to move in that direction, and I'm not saying that it will, I'm not even saying that it can necessarily, because number one, it's closely regulated. Number two, I'm going to guess that the military brass, who essentially drive the bus on a lot of this stuff, aren't necessarily interested in having a bunch of Silicon Valley types sit there and say, you guys are doing war all wrong. This is what you should do instead of that. But I do think that the process has flaws and that we're probably going to end up in some kind of a hybrid. And I have a feeling that's weighing on these things just a little bit. That's my suspicion. The other thing, and then this is what I wanted to show you really quickly. I'm just going to take a look at this over a longer period of time. As you can see here, this gives you a sense of what the historical earnings multiple for these companies is relative, to history and also to the broad market. So if I put the SPX in here, we can see that the SPX trades at much higher multiples than defense does. And also, there's, in fairness, because EPS typically grows faster, the S&P cap-weighted indices are always going to have the big winners in there. So the best performing publicly traded companies are going to land in there. They're always going to trade at a premium. Same thing with CSX. We were just looking at that one too. As it's a rail company, this is not new technology. It's an industrial. You can get a good business at a reasonable valuation, and that's pretty much what it's going to be. You're never going to get the exceptional growth out of it. I think the same thing is true here. Like I said, I like the space. I'm totally fine with it. But as you can see, and let me get rid of SPX so that you guys can get a better look at this. But as you can see, it's, it's a little bit towards the lower end of the range. Let me just draw a line here. So these are the historical valuations for it. Has it traded at a higher turn? Sure. Mid-high 20s. Mid-high 20s is too high for this space. If you get into this space, you probably want to turn seller. You get into this space because it's not as economically sensitive, got beaten up along with everything else in the market, but was it really at risk the way, say, consumer discretionary was? Well, no. They work on a cost-plus basis. Military conflict persists. The budget wasn't going to change that much. So, here we are. We're probably a little bit below average, right? So the average is 18. We're trading slightly below that, probably. It's about a turn cheap. It's reasonable. So I think it's totally fair. But don't expect it to trade back up to 24 times. I don't think that's the right turn for that. Okay, let's move on. I'm in both Tesla and Uber, Bob says. Lately, it seems to me the movement has become mutually exclusive. When Tesla moves up, Uber goes down. Consider Uber, September, in the money, 80, strike, out of the money, 90 long calls, thoughts. Yeah, I like Uber. What's interesting is that there was some news that just came out. You probably saw it with respect to Waymo and Uber. Let me see if I can see who... find that story. And also Dan Ives, from Wedbush, he also had some stuff to say about Tesla, so you might want to look up those stories. If I can find it, I'm going to share it. Uber CEO says that the Waymo robotaxis on its app in Austin are busier than 99% of human drivers. That was from 4 weeks ago. But it was Dan Ives and Chamath who also were saying that they definitely think that Tesla, partially because of the cost, because of the amount of data, because of the number of cars, were likely going to do well. I don't think that there's anything wrong, by the way, with having a little bit of each of these. My biggest concern so how would you get exposure to Waymo? You could get that through Alphabet. As I've previously said, my concern about Alphabet is more than 70% of their revenues come from search. And this was not as much of a priority. Look, Alphabet was on my short list of names at the beginning of the year, but it's pretty clear to me that they are losing some traction to large language models. People are using chat. They're using Grok. Instead of using Google search, despite the fact that they're incorporating Gemini into the search, and I tend to use all of these things myself, but it is a risk factor, whatever you might say about their other businesses. So that's the only tweak to it. But I think owning a little bit of each of these is probably not a bad idea. In the money calls, so let me just get back to which ones you had. The 80s for Sept. Okay, well, let's just take a look at their calendar. So let's just punch this out to the end of Sept so we can see this. So we're going to have earnings in August, so you will capture that, which is good. I don't mind, by the way, owning options that extend past Labor Day, it should be said. We do sometimes see that implied volatility for just after Labor Day holds up a little bit better. So there's kind of an anticipated ebb in volatility that can sometimes take. That's not to say it doesn't happen, but it is not uncommon to see implied volatility for August a little bit under the implied volatility for September, as we adjust through the calendar. September, a lot of people may not realize this because I think October is probably more famous because we've had multiple crashes in October. But September is statistically, it can be quite volatile. So I like the fact that you're owning September options. And, the nice thing about having this in the money call is that you're going to be, you're going to be reducing the amount of decay that you have. So let's just see quickly. That's how much extrinsic premium you're going to be spending. So we'll call it 510 on that strike. Yeah, I mean, that's pretty good, right? Because so you're long an option with about $5 of extrinsic value and you're short an option with about extrinsic value of about $5. So you're not going to have a whole lot of decay. It's a way to get some upside, asymmetric upside probably, because it's already in the money. So that's fine. Yeah, I like that trade. Okay. Linda B., could you please tell us what your thoughts on CHIME's IPO? I don't personally... Were we asked this question on Friday? Somehow I think we were. I vaguely recall that we were. I will tell you, Linda, I don't have that much thoughts about CHIME's IPO. I apologize. I just haven't really taken a close look at it. I may pay a little bit more attention, but I hadn't been paying much attention. Unfortunately, I only have so much room in my brain and hours in the day. It just wasn't one of the things I was paying a lot of attention to. I'll probably have to take a look. So Monday morning quarterback, as I previously said, had trouble with the UnusualWhales discount, but then Steven said, I got the discount a while ago, and it was 20%. Okay, so basically, I guess what we need to do is just contact them and just ask and make sure that that it's all good. MM says, I'm showing Intuitive Surgical's earnings on July 22nd. Bingo. That's what I expect. So, like I said, they've never reported before the 18th of July for any Q2 earnings in the last 11 years. That's the first thing. Secondly, like I said, you have the July 4th holiday, which is going to fall, I think, on a Friday this year. So, does that mean that they're more likely to accelerate and do it one day earlier or a little bit later? I think a little bit later. Tuesdays and Thursdays. We know Bloomberg's date is almost certainly wrong because they've never reported on a Friday. Doesn't mean it can never happen, but it's highly unlikely. So yes. Actually, MM, I'm curious. What source, if you don't mind, what source are you using for that? Because we just identified 4 sources. And all 4 of those sources, Zacks, NASDAQ, UnusualWhales, and Bloomberg, all have the 17th or the 18th. I believe, as you do, that it's on the 22nd. And the options market clearly believes that too. So we'll all be very curious to know what source you're using, because I think that's... do you have any idea on what's going to happen with Dollar General? Oh, my God. These companies... Here's the problem. And I don't want to go on some kind of a populist rant right now, but the fact is, Dollar Tree, Dollar General, these retailers focus on, the lower end consumer, and the lower end consumer has not seen their wages, have not seen their incomes increase meaningfully. This is partially due to just broken immigration policy, among other things, but they have not seen their wages go up, but prices have gone up. In many cases, they've gone up dramatically. And We don't have policymakers who try to correct those mistakes. They just try to slow them from getting a whole lot worse. What I mean by that is if bananas, and I'm going to use very specific examples that I happen to know. Bananas at the Safeway closest to me, because my kids use a ton of these things. They use them every day. They put them into smoothies. Bananas were 49 cents a pound about 4 or 5 years ago, before the pandemic. 49 cents a pound for regular bananas. 69 cents a pound for the organic ones. They are now 99 cents a pound for the regular ones. Okay? They're more than double the price. And they haven't been going up the way they had been. I mean, I watch them go 49, 59, 69, 79. Every single time I walk in, it's like a different price. You know, it's like, it's up 10%, it's up 10%, it's up to every, you know, it just seemed like this was going on month after month. So what has happened, of course, is that we seem to have gotten inflation under control, but we have not had any deflationary effects, which is to say that the prices have not reverted. Those of you who have watched the live stream for a long time know that, Mark Guthner, who studied this quite extensively going back centuries, made the observation that in history, when we had the concept of hard currency, there were periods of inflation when demand outstripped supply. And that could happen for a number of reasons. You have a demand spike or you have a supply decrease. Oftentimes, we would get periods of inflation surrounding wars. That's not surprising. There's going to be greater demand for some goods. There's going to be lower supply. These things often had inflationary effects. In a hard currency world, when things normalized, prices would revert. But in a fiat currency world, that's not what happens. Policymakers don't try to correct their previous mistakes. They just try to slow the pace of inflation. So they'll say we have a 2% target rate, and if you've had 50% price inflation, if they can get it down to 2.5 or 2, they call that a win. That doesn't really help the people that go to Dollar Tree and Dollar General, though, whose incomes have not increased. MM says Schwab's quote page. Okay, so you got that from Schwab. Excellent. And also options play. Good. I'm pleased to hear that options play has it right. Or at least it's still an estimate, but we agree. So that's good news. So the problem with Dollar General and Dollar Tree is not so much a functional or operational problem with those stores. It is a systemic problem with the demographic that they serve. And that is that the amount of money that those people are making does not buy the goods that they need. And unfortunately, it's really difficult when you run a narrow margin business and you're targeting that demographic to solve that problem. So I'm hopeful. We have seen some wage increases, and we have seen, so where their situation is going to get better is when we see real wage increases for the bottom half of the distribution. So people who are below the median, not the mean, but below the median, because the mean gets thrown off by super high earners or whatever. But when we see real wages increase for the lower half of the distribution, and we continue to keep inflation under control. And it does seem like inflation, the pace of inflation has slowed, which is good. But I think it's going to take a little bit of time. So I still think it's going to be some trouble for Dollar General, Dollar Tree, for all of those. I would add, take a look at Target, for example, wasn't great for them the last time either. Broadcom. Let's take a look at how this one looks technically. So I do like Broadcom, but let's see where we're at right now. So, technically we're still looking pretty good. See, I'm just going to get rid of this. I'm going to adjust this to the 150. Although the only problem I have is this looks like a ticklish level. See here? Eek. We really need to, but this could be the catalyst, right? This could definitely be the catalyst. So let's take a look at the implied move relative to its own history. So we're just going to go to earnings, see how options prices look relative to their own history. Pretty reasonable. We like that. So like I said, difficult level, but options are reasonably priced. All right, I apologize if this is causing the image to slow down. What we figured out is that when I'm sharing my screen, which is 1080, high definition, all that kind of stuff, and we're sharing that with you, and it's also trying to grab my picture. It's not, these are going through different processes, but it just chews up a lot of upload bandwidth. And although this thing supposedly has the capacity to do it, seems like it's not always working. So this is just the default strategy that Ops Display comes up with here. In the money call spread, $20, it's already $9 in the money. So this is really risking about $11 on a $250 stock. So about 5% of the current stock price, maybe a little bit more or less. Your mileage may vary depending on tomorrow's prices. I would probably do it this way myself, where I would actually go for something that was, you know, at the money or just out, like this. And if you just wanted to try to target this specific event, you know, you don't even need to go out a couple of months. One of the reasons for this is that if you're going to get into a debit vertical spread, you want it to monetize, right? So let's just go back here. What was the historic move? So last time it moved up 8%. Time before that it was up 24. So let's just assume 8. So that's 270. Yeah, I don't even think you need to go up this high. Maybe like something like this to make a bullish bet. You're betting on that breakout. You can see right here, we're right up against it. Right up against those prior highs. But yeah. Okay. Let's see here. By the way, thank you for sharing that about Schwab. So for anybody out there who's using Schwab, whatever their algorithm is, obviously I tend to agree with it. I like it. And you guys can see I use Bloomberg, I use UnusualWhales, I use these tools, but I don't always agree with them. So that's one of the quick things I would point out, is that even reliable sources is probably not a bad idea to sometimes, you know, compare them to each other and, you know, eye them skeptically. You know, just like you read a news story, you know, if you try to read between the lines and double check the facts. Sometimes not everybody does that. I don't know. I mean, I could also be wrong about the 22nd, but I think I've sort of led you guys down, given you the breadcrumbs for how I went down that path, and you can choose to agree or not. Okay, so what do we have here? Tucker D Dog says Broadcom in the AI space and infrastructure rather than the chip manufacturer like NVIDIA. I heard some talking heads saying more money moving into support services, infrastructure, chip maker suppliers now. Could be. Could be. What I know is that there's a secular tailwind for the entire space. So Michael Anthony, you're asking about Allarity Therapeutics, it looks like. I don't follow penny stocks. So I don't really have a whole lot to contribute on that. It's not my thing. A couple of reasons for this. I mean, first of all, just so you guys know, the fund that I was running a 40 Act fund, and the 40 Act fund that I was running we had a strategy mandate, and we only invested in large cap companies, right? So my focus has generally been large cap stocks. And it's not to say I don't look at mid cap stocks. First of all, mid cap stocks are the former large cap stocks. Even small cap stocks, you could be dealing with $1 billion business. So these aren't necessarily small businesses. I'm just telling you that my focus was principally going to be in things like Russell 1000 constituents if we're looking US. But penny stocks I don't look at, and one of the reasons I don't look at penny stocks is because I also tend to try to look at things with an options overview. And because of that, penny stocks are options themselves, right? So I'm not going to say people should or shouldn't trade them. I know some people have done exceptionally well, but this is a company that's, it's like their market cap's the size of a veterinary practice, right? This is a really small business. No revenues. It was an $8.5 million company at the end of last year. It's doubled in value almost since, I think. This is interesting. Now, I want you guys to pay attention to this because I think you'll find it interesting. I'm going to blow this up. I don't know if you guys can see that. Let me see if I can. Hopefully you can make these digits out. But this is what I actually want you to note here because oops. Well done. I did that real well. That button did not do what I thought it was going to do. Where'd my cursor go? Okay. I managed to blow something up. Okay. So I'm going to try to bring back this screen, but I want you guys to pay attention to this because this is something that I think, although I don't have an opinion on Allarity Therapeutics, and it's a penny stock, and I don't really focus on those, this is what I want you to see. Nope, but I'm going to have to do this. All right. Watch me fumble around like a complete buffoon here. All right, once again, try to blow this up. This is the number I want you to pay attention to, where my cursor is, minus 12.9. Hopefully you guys can all see that. This is the enterprise value. So the company has a $13.5 million market capitalization, and it has a negative $13 million enterprise value. What is enterprise value? Enterprise value is the market capitalization plus net debt. The company does not have any meaningful debt. It's got $1.4 million in debt. It has $27.7 million in cash. And what that means is that this company is actually right now trading for less than the amount of cash that the company has on its balance sheet. So one way to think about that is if you just liquidated the whole thing and took the money, you would have 2x, right? That's the way to think about this. Again, that's clearly not the company's intent. It is not unheard of for this to happen in companies like this where you are trying to develop and actually, okay, so Michael Anthony, that's the point you were trying to make. I see that. Okay, I'm just going to put that up on the screen because you actually get to that. I didn't see that. But this is the point that I would make, is that it is sometimes the case that you're going to find companies that are trading for less than book value. You are going to find companies that are trading for less than just the cash that they have on their balance sheets. Such is the case here. This company, if you bought all of the outstanding stock at the prevailing market price, you're not going to be able to do that. But if you went out there and you said, okay, if you could, you'd buy $13.5 million worth of stock, you could liquidate the company, take the cash, and be done. And double your money. That can't happen. The reason it can't happen is because if you tried to buy all the stock, of course, it would go substantially higher. But I can see that this is one of the rationales that people have, right? So the idea is that the company is, working on an innovative therapy, an innovative treatment, and if it hits, presumably it's going to be worth a multiple of this. It's going to have significant negative cash flow until such time we can see that it's got, spending $19 million a year in cash. That's the reason they have so much cash on hand. That's the reason companies go out and try to raise money so that they have cash on the balance sheet to use. But I thought that was something that's important, and you should probably try to pay attention to when you look at these things, because I very often will point out the market capitalization and enterprise value, but we don't see this that often, so I figured it was probably worthy of note. Okay, so with that, I have chewed up pretty much the better part of an hour here. So unless there's any other questions, and again, I apologize, penny stocks, not my thing. CHIME IPO, haven't really looked at it. For some reason, I think Mark talked about that last Friday, so you might want to go back. And so Michael Anthony adds, by the way, that Allarity Therapeutics is going to do a stock buyback, they said on their earnings call. That's highly unusual for a company with this kind of negative free cash flow, where generally speaking, the reason you don't raise money to fund a business's operations while you try to develop new technology, therapies, whatever, so while you operate a business at a loss, simply so that you can buy the stock back. That's not a very efficient use of capital. That's fine. If they said that on their earnings call, I'm sure that's what they said. That's all fine. I didn't listen to their earnings call. I don't follow penny stocks. It is an interesting situation, though, whenever I see a situation like this, though, where the company is worth less than the cash on the balance sheet. That does strike me as kind of interesting. Roger P. Not worthy to spend so much time. You're probably right. And we'll probably wrap it up there. But what I encourage is for everybody to come back on Wednesday. Like, notification bells, subscription, all that kind of good stuff. And I will join you here on Wednesday after the close, and we will talk about more of the macroeconomic drivers for the market and take a look at more upcoming catalysts. We'll see you then. Thanks for watching.